So right now, the stock market is setting all-time highs, but Wall Street's ultimate fear gauge is actually flashing red. And, that only happens maybe 20% of the time, so it tells us something pretty wild is happening under the hood.
It definitely breaks the traditional rules. I mean, historically, you'd expect a really sleepy VIX, which is the index that measures implied volatility when equities are soaring. The VIX usually spikes when people are panic selling and buying put options for protection. It's supposed to move in the exact opposite direction of the S&P 500.
But that is just not what's happening this week. Like, the S&P 500 rallied and the VIX went up right alongside it. So, looking at the stack of financial reports, earnings calls, and climate data you sent over for our exploration of the source material today, our mission is to figure out exactly what these bizarre market anomalies actually mean for you.
Because what we're witnessing right now is it's basically a mechanical reaction to sheer exuberance. When the market rallies this hard, traders just rush to buy call options, which are essentially these leveraged bets that the market will go even higher. I mean, on Tuesday alone, over 4 million S&P 500 index calls were traded. That's a new all-time record volume.
Wait, so if I'm understanding the mechanics correctly, you have millions of traders placing these highly leveraged bets on the market continuing to go up, and that extreme demand is what forces options prices higher.
Exactly, yeah. Because implied volatility is a core component of an options price. All that bullish call buying artificially inflates the volatility metrics. So the fear gauge isn't measuring fear right now. It's actually measuring this frantic, unbridled optimism. The sheer volume of money chasing the rally is just keeping the VIX bid artificially high.
Which really brings us to the broader pattern we found in the sources. We aren't looking at one neat, unified trend across the global economy today. Instead, we're looking at how different players are allocating capital in times of, well, severe constraint. We have tech billionaires trying to ignore physical limits, traditional businesses getting trapped by the weather, and sovereign wealth reshaping global entertainment.
Yeah, we're seeing these massive tectonic plates shifting under the market. It's driven by players who have seemingly bottomless pools of capital colliding with the very real physical constraints of the real world.
Right, so let's start with a company acting like there are no constraints at all, which is SpaceX. You sent over their latest earnings report, their first since their June 2026 initial public offering. And if you just glance at the top line, it looks incredible. Second quarter revenue nearly doubled to $7.8 billion dollars. And a lot of that was driven by a $1.6 billion profit from Starlink. But the stock tanked 13% after the report dropped. I mean, if Starlink is so profitable, why did the market punish them?
It all comes down to capital expenditures. The market punished them because of how much cash they're burning on future infrastructure. They spent a staggering $18.4 billion in a single quarter.
Hold on, 18.4 billion. That's more than double their total quarterly sales? Where exactly is all that money even going?
That's the pivot that really caught Wall Street off guard. SpaceX isn't just building reusable rockets anymore. They are aggressively attempting to become an artificial intelligence cloud infrastructure giant. Like they want to take on Amazon and Microsoft by renting out immense amounts of AI computing power to other tech companies.
I saw the energy purchases in the report, and honestly, the physical scale of this is just hard to wrap your head around. During the second quarter, SpaceX purchased $295 million worth of Tesla Megapacks. Why do they need utility-scale lithium-ion battery systems?
They're installing them to power their new Colossus data centers, which are located in the greater Memphis area. Elon Musk actually laid out a goal to have 20 gigawatts of power and cooling live online by the end of 2027. And to put that physical requirement into perspective, a typical nuclear reactor produces about 1 gigawatt of power. So they're trying to build a digital operation that requires the energy footprint of a small nation.
And here's where I really have to introduce some serious skepticism, because the tech industry loves to talk about the cloud as if it's this invisible, ethereal thing. But renting out AI compute requires incredible amounts of physical infrastructure. You can't just drop a 20-gigawatt operation into a community without breaking things.
No, you can't. And those physical realities are catching up to their ambitions really fast.
They absolutely are. SpaceX is currently facing a lawsuit from the NAACP in federal court. Because the local grid couldn't handle their power needs, SpaceX installed dozens of natural gas-burning turbines to generate power for these Memphis facilities. And now, local residents are dealing with the noise, the air pollution, and the smell. The lawsuit alleges SpaceX used these turbines without the necessary federal permits or pollution controls. In their own financial filings, they had to record a $354 million legal accrual for probable litigation losses.
And that tension highlights the exact difference between software development, where you can move fast and break things, and industrial infrastructure, where breaking things gets you sued. It really raises the question of whether this frantic land grab for AI market share is distracting SpaceX from their core aerospace business. I mean, the space segment actually posted a $542 million net loss for the quarter.
Yeah, the executives claims they'll hit $100 billion in annualized recurring revenue from these cloud services by December, but they are bleeding cash to get there. The AI unit lost $1.2 billion in the quarter. It kind of feels like they built this ocean of capacity, and now they're desperately trying to find enough clients to fill it before the costs sink them.
Right, and while the jury is still out on whether SpaceX can profitably challenge Amazon and Microsoft, the companies selling the physical picks and shovels for this AI gold rush are seeing immediate, undeniable windfalls. Just look at AMD. Their data center sales are up 107% year over year.
And it isn't just the big-name chip makers, right? In your notes, you highlighted companies like Qnonity, which is a specialty chemicals and materials company that spun off from DuPont in late 2025. Their stock is surging because they solved the physical bottlenecks of this new technology. But how exactly does a chemicals company fit into an AI boom?
Well, because as AI moves from software in the cloud into the physical world of devices, vehicles, and machines, the hardware requirements change drastically. When you pack that much AI computing power into a physical space, the chips get so hot they will literally melt themselves if you don't engineer entirely new chemical pathways to pull that heat away. You have to package these incredibly complex semiconductors, manage the immense heat, and ensure the signals travel reliably between chips.
So they are literally creating the thermal packaging that keeps the hardware from catching fire.
Precisely. Quintity's Interconnect Solutions segment, which addresses these exact thermal and signal integrity challenges, saw growth of over 50%. When companies like SpaceX attempt to build 20-gigawatt data centers, suppliers like Quintity provide the necessary foundation that makes the physics actually work.
Okay, so SpaceX is aggressively spending against physical constraints, but if we look at traditional markets, they're entirely trapped by them. Specifically, they're battling the weather. Looking at the climate and agricultural data you provided for the United Kingdom this past July, I mean, the economic translation is just brutal.
It is. The UK just experienced its driest July since 1836. Half of England and all of Wales were officially declared to be in drought conditions.
What does a drought of that magnitude actually do to the broader food chain?
It basically causes a shockwave. The UK cereals and oilseed harvest is projected to drop by 2.5 million tons. That makes it the worst harvest since records began in 1984, costing farmers roughly $522 million in lost revenue. When you lose that volume of barley, oats, and rapeseed, it impacts everything. Those crops are foundational. They're used for breakfast cereals, vegetable oils, brewing beer, and critically for feeding livestock. And farmers simply don't have the pricing power to absorb a $500 million hit without passing it along.
But the supermarkets are terrified of passing that cost onto you, the consumer, in the form of higher sticker prices. They know that seeing a jump from $2 to $3 for everyday vegetables causes immediate outrage. So they engage in a pricing game known as shrinkflation. How exactly does the behavioral economics of this work?
The mechanism is entirely psychological. Human brains are highly attuned to absolute numbers. We notice a price tag changing instantly, but our brains are terrible at spatial geometry. Grocers want to maintain the illusion of price stability, so they exploit that cognitive blind spot.
It's so striking to see how this plays out in the vegetable aisle. You'll pay the exact same amount of money, but you'll be taking home a visibly smaller head of broccoli or a lighter bag of potatoes. The yields are down, the crops are stressed from the heat, so the physical size of the produce shrinks. And when domestic supplies fail completely, supermarkets are forced into emergency logistics. The UK is currently importing broccoli and iceberg lettuce from Spain in August, which is historically unheard of.
Right, the farmers and the grocers are trapped. They have almost zero pricing power because the commodity they sell is heavily constrained by nature. But then you have companies completely detached from those physical constraints, allocating capital based purely on consumer psychology. E.l.f. Beauty just reported earnings that provide a masterclass in this exact dynamic. According to the reports, E.l.f. received a one-time windfall, a $50 million tariff refund from the federal government. Most companies would take that cash, report an incredible quarter to Wall Street, and just hand it to shareholders. But E.l.f. decided to run a real-world economic experiment instead. What exactly did they test?
They used that capital to test exactly how sensitive their customers were to price. They went across 80% of their entire inventory and lowered prices by $1. They wanted to see if dropping the price would stimulate enough demand to offset the lower profit margin. And the data they got back was incredibly revealing. For 90% of their items, lowering the price did absolutely nothing to increase the number of units sold. Consumers were already perfectly willing to buy those products at full price. Why is cosmetics so different from groceries in this regard?
It comes down to something called the lipstick effect and just deep brand loyalty. Cosmetics are often viewed as affordable luxuries. The experiment proved that their core products, like their popular Power Grip Primer, were highly inelastic. Consumers valued the brand enough that a discount didn't change their behavior at all, whereas in the grocery store, brand loyalty is easily broken by a 50-cent price hike.
So E.l.f. immediately walked back the price cuts on that 90%, and they only kept the lower prices on the 10% of their inventory where volume actually spiked. For example, they dropped a Cream Glide lip liner from $3 to $2, saw a huge jump in sales, and decided to keep it there. It's incredibly surgical, data-driven pricing power.
Exactly. They basically use their windfall to map the exact boundaries of their customers' wallets.
I look at that surgical precision, and then I look at a company like Flutter, the parent company of the sports betting giant FanDuel, and Flutter is using their cash like a sledgehammer.
Oh, Flutter is facing a serious problem in the U.S. market. FanDuel has historically been the dominant player, but over the last year, they began losing significant market share. They misjudged their customer base, pulled back on promotions, and the competition just ate their lunch.
So to buy those customers back, Flutter is preparing to burn $270 million in the second half of 2026. They're dumping cash into aggressive rewards programs, better promotions, and features like refunding bets when a player gets injured. E.l.f. tested exactly what their consumers wanted. Flutter is just throwing $250 million at the wall because they're terrified of losing their dominant position.
It really is a stark contrast in capital allocation.
It is. Now, before we transition to our next topic, if you find these market mechanics and consumer psychology insights fascinating, you can find Financial Candy, Brain Candy, and classic audiobooks over at clairenaratio.com.
And moving from companies using millions in cash to buy back retail customers, we're also watching entities use billions in borrowed cash to buy entire industries outright.
Which brings us to the mega buyout of the week. The video game publisher Electronic Arts, the studio behind global franchises like The Sims, Mass Effect, and EA/FC, is being sold for $55 billion. The buyers are a consortium led by Saudi Arabia's Public Investment Fund, or PIF, and Affinity Partners, which is led by Jared Kushner. How does a purchase of this scale actually work mechanically?
The sheer mechanics rely on a structure called a leveraged buyout, or an LBO. The consortium is taking EA private, removing it from the public stock exchange. But they aren't using $55 billion of their own cash. They're putting up $36 billion and borrowing $20 billion from investment bankers at JP Morgan.
And here's the kicker that always fascinates me about LBOs. They tie that $20 billion debt directly to Electronic Arts itself. I always think of an LBO like taking out a massive mortgage to buy a mansion, but forcing the mansion to pay its own mortgage.
That's a good starting point. But realistically, it's more like forcing the tenants of that mansion to skip meals to pay the mortgage off faster. When a business is suddenly saddled with billions in new debt, the new owners almost always implement aggressive financial engineering to service those loan payments. In the gaming industry, analysts are already bracing for severe cost-cutting, mass layoffs, and a heavier reliance on aggressive monetization of their biggest franchises. The pressure to generate cash to pay down the debt becomes the singular focus of the company.
But I look at this deal and I have to ask, is this purely a financial investment designed to squeeze cash out of video games? Or is this a vast, soft power play? Because EA isn't just a software company, it's a cultural institution.
Well, the Public Investment Fund already controls Newcastle United and several clubs in the Saudi Football League. By acquiring EA, they instantly gain a direct relationship with 20,000 professional players, 750 clubs, and 35 leagues across the globe through the EA/FC franchise. It embeds them deeply into the fabric of global sports entertainment.
And that influence creates immense cultural tension. You have advocacy groups and gamers actively petitioning against this buyout. Now, before we get into the details, we want to make it absolutely clear to you that we aren't taking any sides or endorsing the viewpoints of these advocacy groups or the buyers. We are simply reporting the ideas and concerns contained in the original source material.
Right. And the cultural clash stems from the fact that a game like The Sims heavily champions inclusivity and allows for LGBTQ+ relationships.
The fear among players who are petitioning is that a company majority owned by the Saudi government, where interpretations of Sharia law severely punish same-sex relationships, will quietly censor or alter the cultural themes of these games to comply with domestic politics.
And if we want to understand their patience and strategy as investors, we can look at how PIF operates in other sectors. Like, they're the largest shareholder in Lucid Group, the electric vehicle manufacturer. Lucid is burning through capital at an astonishing rate. They posted an adjusted loss of $901 million in the second quarter of 2026 alone.
Lucid is undergoing a complete operational reset right now. They're delaying the release of their crucial midsize vehicle until the second half of 2027, and suddenly pivoting their resources to build prototype robotaxis for Uber. Most public companies would face an absolute shareholder revolt with that level of cash burn and product delay.
But because Lucid is backed by the sovereign wealth of PIF, they have a liquidity runway extending well into 2027. PIF deploys capital on a timeline that traditional venture capital simply cannot match. Whether they're funding a struggling EV maker's pivot to robotaxis or taking on $20 billion in debt to capture the video game industry, their strategy relies on outlasting the competition.
And all of these global capital deployments, from PIF's $20 billion bank loan to SpaceX's $18 billion infrastructure spend, they rely entirely on the underlying cost of money. And the institution that controls the cost of money in the United States is undergoing a radical, deliberate culture shock.
We're talking about the Federal Reserve. Kevin Warsh took over as Fed chairman in May 2026, and in just a few short months, he has actively dismantled decades of established Fed communication strategy.
For the last 20 years, the Fed has operated on the principle of extreme transparency. They provided what's called forward guidance. Fed chairs would practically telegraph their moves months in advance, spoon-feeding the market, holding investors' hands, and telling them exactly what they plan to do with interest rates so no one got startled. What is Warsh doing differently?
Chairman Warsh is aggressively curbing that guidance. He's giving cryptic, often evasive answers during press conferences. He even refused to submit his own projections for the famous dot plot of future rate expectations. And now there are credible discussions within the Fed about cutting their historical 8-meeting-a-year schedule down to just 4 or 6 meetings.
The stakes of introducing this level of silence and uncertainty are astronomical, not just for Wall Street, but for you. If the Fed goes silent, it's not just algorithms that have to adapt. It's anyone trying to figure out if next year is a safe time to buy a house, get a mortgage, or rebalance a 401k. And for the U.S. government, which is sitting on $31.1 trillion in public debt, it's terrifying. The Treasury Department estimates they will spend $1.3 trillion just on debt financing costs this year alone.
Because when you remove transparency, you introduce volatility. Bond investors demand to be compensated for uncertainty. If the market suddenly has to guess what the Fed will do over longer stretches of time without meetings, we could see a phenomenon known as a bear steepener.
Can you explain the mechanics of a bear steepener? Like, how does that actually happen?
A bear steepener happens when long-term bond yields rise much faster than short-term rates. Investors essentially say, if you aren't going to tell us what the economy is doing, we demand a much higher return for the risk of lending our money out for 10 or 20 years. So the interest rates on long-term debt just spike.
And if long-term rates spike, it crushes the federal budget because rolling over that $31 trillion debt becomes catastrophically expensive.
Yet the current administration actually supports this shift. Treasury Secretary Scott Bessent recently described Warsh's strategy as a much-needed market detox. The rationale is that investors have become lazy, trading on Fed promises rather than underlying economic health. Warsh wants a regime of continuous market repricing. He explicitly stated that market participants need to play the ball, not the referee. He wants the market reacting to real economic data, not parsing the vague language of Fed officials.
Pulling all of these threads together today, it's clear there is no single unifying narrative tying the global economy into a neat bow. Instead, we're observing powerful, distinct forces reshaping the landscape simultaneously.
Exactly. We're watching distinct tectonic plates. You have tech billionaires willing to spend $18 billion in a single quarter, risking their core businesses to build the physical infrastructure of AI. You have traditional agriculture and retail sectors finding their pricing power completely erased by the physical realities of historic droughts. And you have sovereign wealth funds using billions of Wall Street debt to buy cultural influence in the entertainment industry.
And presiding over all of this capital movement, you have a Federal Reserve chairman actively pulling away the market's safety blanket, demanding that investors figure it out for themselves. Which leaves us with a critical question to consider as you watch the markets this week. For the better part of a decade, Wall Street algorithms and everyday retail investors alike have been meticulously trained to trade based on what the Fed promises to do. If Chairman Warsh actually succeeds in his market detox and goes silent, do modern investors even remember how to price risk on their own, or have we entirely forgotten how to ride the bike without the training wheels?
It really is a fascinating real-world experiment we're all living through.
Thank you for joining us today, and we'll be back soon to help you unpack the mechanisms moving the markets.